Welcome to Caribbean Business Review, where insight meets impact. We bring you economic and financial updates, sharp statistical breakdowns, and data-driven insights on the forces shaping the region. Smart analysis, bold ideas, real Caribbean intelligence. This is CBR. Hello, everybody, and welcome. This is Caribbean Biz Review. This is our second episode. My name is Joseph Cox. This week, however, I'll be flying solo as my co-host is a bit under the weather. And Sherry-Ann, we send our best wishes, and we do hope that you'll have a speedy recovery over the next couple of days. Now, coming up on this program this week, we have a couple of announcements to make. One, we wish to formally welcome on board MKR Radio, who will be carrying our broadcast, our transmission, as well as I want to introduce you to a new facility that we are bringing on board, but just that in a few moments. Coming up on our program today, though, we have our strategy brief, which will be in a few minutes, and that will be followed by our market watch and our global pulse news reports. Because indeed we are living in such interesting times, my goodness. From one week to the next, one never knows what is coming at you. Then we get into a discussion on Island Insights, and this week our special guest will be Mr. Darwin Telemack, who is the chairman of the Port Management Association of the Caribbean. And we are looking, of course, at logistics, whatever the implications of all of what is going on our ports, and can we cope, and what are strategies we need to put in place to treat it same. Then we transition to another interview with this time Dr. Devon Gardner, who is a senior partner at the Institute for Innovation and Growth, and we are looking at reformation of our electricity sector, because it seems to us that a number of countries across the region are looking to revise their electricity acts, and one wonders what are some of the pitfalls that they need to avoid going forward, so we don't end up back in probably the same situation where we are, and can move forward with dispatch while embracing not just hydrocarbons, but looking also at renewable energy solutions effectively. After that, we'll get to our game changer and playbook, where we'll basically be wrapping up what's going on today's program, looking at some of the elements coming out of it and what we hope to achieve in the following week. But then, to be frank with you, ladies and gentlemen, planning from week to week is a very dangerous thing nowadays in this world, where in a matter of minutes, decades of tradition can be dismantled. But as I promised earlier, we do have another important announcement to share with you, and this time it will be the launch, to particularly geared at our subscribers to this program. But nonetheless, for the first instance, we will be sharing it freely for all, so that you will see what it is about, and that is the Caribbean Financial Dispatch. Now, this will be a weekly publication where we look at some of the important and interesting news items right across the region and across the globe, as well as giving you some deeper insights into some statistics that may well prove relevant in your day-to-day planning. And so therefore, we want it to become part of your weekly reading material. So with that said, ladies and gentlemen, as we continue to look at what's going on around us, I mean, right now we're confronted with the argument that the US has proposed a 50% tariff for goods coming out of the European Union. And there's, of course, a threat for a 25% tariff to be applied to iPhones made outside of the United States. So we are all going on to very, very interesting times. But coming up right after this will be the CBR briefing, which will resume just after this break. One of the unspoken rules of public speaking is to leave your audience wanting more. Now, whether by design or not, the Planning Institute of Jamaica has certainly succeeded in that regard, as their recent quarterly press briefing has certainly engendered food for thought. More precisely, questions abound, and in this era of expanded media platforms, it creates a dynamic for even more transparent and meaningful public discourse. In that regard, the CBR doors remain open to the PIOJ to have a conversation about the issues related to the performance of the Jamaican economy and the recently released poverty data. However, in the interim, here are some questions which come readily to mind. 1. Can a 0.8 quarterly GDP growth rate be considered strong recovery when the economy contracted by 0.8% over the entire 2024-25 fiscal year? 2. How does the claim of broad-based growth align with declines in major sectors like agriculture down 4.7%, mining down 4.2%, and electricity and water down 1.1% for fiscal year 2024-2025? 3. Why is the construction sector's 1.5% growth deemed significant when it includes a highly unusual 2,355.6% increase in NHT housing starts and 632.1% growth in Port Authority capital expenditure, which are likely one-off spikes? 4. Given a fall in stopover arrivals down 4.7% and cruise visitors down 13.4%, how credible is the claim that the hotels and restaurant sector grew based on a modest increase in average stay length? Is this consistent with actual tourism demand trends? 5. If alumina production declined by 2.4% due to lower demand, how is this reconciled with claims of increased external demand driving overall GDP growth? Is the external demand narrative sector specific? 6. How can inequality be said to have fallen significantly based on a 2023 Gini coefficient of 0.3560 when the 2021 figure was 0.3991 and there was no data collected for 2022? At best, isn't this indicative rather than being conclusive? 7. What explains the emphasis on increased crop productivity when traditional export crops fell by 23.5% and animal farming declined by 1.5%? 8. Why does the report project GDP growth of up to 2% for fiscal year 25-26, despite explicitly citing major downside risks like factory downtimes, hurricanes, and reduced global demand? What informs the optimism? 9. Given the high public reliance on remittances, some $3.4 billion in 2023, and their noted decline, how sustainable is a poverty reduction narrative without deeper economic transformation, and especially in the context of persistent anemic growth? 10. How does the report's optimistic claim of reduced food poverty at 2.8% in 2023 reconcile with the Ministry of Health's publicly released data indicating that over 1.6 million Jamaicans were malnourished as of May 2024, and with regional findings showing the Caribbean had the highest rate of moderate to severe food insecurity globally at 58.8%? These questions are not intended to diminish in any way the efforts of the team at the Planning Institute of Jamaica who have labored long and hard in the vineyard. Nonetheless, in uncertain times, trust in national statistics must rest not only on data, but on a willingness to explain, engage, and respond in a timely manner. We at Caribbean Business Review remain willing to host that conversation. Until then, we invite our viewers and listeners to reflect on the questions posed, not to sow doubt, but to strengthen the integrity of our public economic dialogue. Welcome to Market Watch, your weekly briefing on the trends shaping business, finance, and economic policy across the Caribbean. I'm Joseph Cox. We begin in Jamaica, where the Consumer Price Index fell by 0.4% in April, mainly due to a sharp drop in electricity rates and lower agricultural produce prices. Inflation year on year stands at 5.3%. Meanwhile, the Bank of Jamaica cut its policy interest rate to 5.75%, citing stable inflation and easing global commodity prices. Also in Jamaica, the government is committing $13.2 billion over the next decade to curb electricity theft, which affects 30% of the national grid. The plan forms part of a broader energy sector overhaul, including reforms to the Jamaica Public Service Company license and the Electricity Act. Turning to the private sector, Separate Limited reported a nearly 32% revenue surge in Q1 to $37.7 billion, but profits dipped as acquisition-related finance costs increased. Meanwhile, Carreras Limited more than doubled its Q1 profits to $1.4 billion, buoyed by higher product prices. From the banking sector, Antigua and Barbuda's Parliament has passed amendments to the Banking Act, mandating basic no-fee accounts and establishing a Financial Dispute Resolution Commission. Meanwhile, Bermuda's banking sector reported $48.2 million in profits for Q4, down over 65% due to deferred tax reversals, but the sector remains well capitalized. In Barbados, Ansa Merchant Bank saw a 24.4% profit increase driven by growth in mortgages and project financing, with assets up 24% to over $300 million. The Bahamas reported a $58.6 million fiscal service surplus in February, helped by surging tax revenues and tighter expenditure. Year-to-date revenue is now over $2 billion, or 57.5% of the annual budget. In broader economic updates, Jamaica's GDP grew 0.8% in Q1 of 2025, though full year 2024-2025 figures show a 0.8% contraction. Growth was led by crude bauxite, manufacturing, and an eye-popping 2,355% increase in housing starts, while alumina, agriculture, and tourism-related services remain subdued. Despite this, Jamaica's poverty rate fell to a historic low of 8.2% in 2023, with food poverty being reported at just 2.8%. Gains were attributed to stronger job growth, minimum wage increases, social transfers, and $3.4 billion in remittances. Elsewhere in the region, Trinidad and Tobago has extended its tax amnesty to August 2nd, allowing citizens to settle outstanding obligations without penalties. St. Lucia is launching a new crop insurance program for banana and plantain farmers ahead of the hurricane season. And in Guyana, Afrexim Bank has officially launched its $1 billion oil and gas financing facility, aimed at empowering local businesses and strengthening Caribbean-Africa trade links. Finally, shipping rates are expected to climb in the coming weeks despite a tariff truce between the United States and China. ShipX CEO Derek Sands says higher demand is driving up freight prices. To respond, the company will launch a new China-Caribbean route via Freeport in the Bahamas by July. We now turn to regional currency movements across CARICOM. The US dollar holds steady in the Bahamas at 1-to-1, while it fetches $159.47 Jamaican in Jamaica, and a high of 218 Guyanese dollars in Guyana. The euro is strongest in Guyana at 2.43, and the British pound tops out at 2.8445 in Guyana. Among Eastern Caribbean states, $1 US equals $2.71 EC, and in Trinidad and Tobago, it trades at $6.80 Trinidad and Tobago dollars. In terms of oil prices, energy futures edged higher at the week's end. West Texas Intermediate crude rose to $61.68 per barrel, up 0.78%. Brent crude hit $64.95, up 0.79%. The OPEC basket climbed to $65.60, gaining 0.91%. Natural gas saw the strongest jump, up 1.97% to US $3.31. Finally, at the week's end, in terms of our stock markets were mostly held steady across the region. Jamaica's JSE index rose 0.07%, Trinidad's All TNT Index gained 0.49%, and Barbados BSC Local edged up 0.04%. The Eastern Caribbean Securities Exchange was flat, while the Bahamas and Bermuda indices also held steady. JMMB Group led gains up 9.62%, followed by Supreme Ventures up by 7.13%. On the downside, First Rock Real Estate dropped 11.43%, and Trinidad Cement fell 8.51%. Sub-indices saw modest movement, with the JSE and TTSC composites both ticking up, while the Caribbean Exchange slipped 0.64%. Now that's it for this edition of Market Watch. I'm Joseph Cox. Stay with us for more insight, analysis, and perspective right here on Caribbean Business Review.
Change. Insight is your greatest asset. At Joseph Cox & Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox & Associates. Insight, experience, impact.
Welcome to Global Pulse, where we track the forces shaping global markets and their ripple effects on the Caribbean and beyond. I'm Joseph Cox. In the United States, long-term interest rates have surged past 5%, hitting a 23-year high following Moody's downgrade of U.S. credit amid a projected $3 trillion debt increase. Rising Treasury yields are pushing up borrowing costs for businesses and households and putting pressure on public spending. Adding to the turmoil, President Trump has threatened a 50% tariff on European Union goods and a 25% tariff on iPhones manufactured outside the US, reigniting global trade tensions. The EU exports over €500 billion worth of goods into America annually. Markets have already reacted nervously. A Global Alliance trade survey estimates potential export losses of $305 billion in 2025, as 42% of exporters now expect declining revenues, up from just 5% before Trump's recent tariff moves. Meanwhile, U.S. inflation pressures continue to build. Business activity improved in May, with the S&P Global PMI rising to 52.1, but input costs and consumer prices surge, raising fears of stagflation. U.S. housing is also under strain. Existing home sales fell 0.5% in April to the lowest April level since 2009, despite a bump in supply. The median price hit a record $414,000. Across the Atlantic, UK inflation rose to 3.5% just days after the Bank of England cut rates. At the same time, government borrowing hit £20.2 billion in April, the fourth highest April deficit on record, piling pressure on Chancellor Rachel Reeves to reconsider her fiscal rules. In the energy sector, OPEC Plus is weighing a 300% increase in oil supply for July. If approved, this could overshoot demand and further dampen oil prices already falling on supply concerns. In Asia, China's exports rose 9.3% in April, led by shipments to Asia and Europe, offsetting a 21% plunge in exports to the US. But domestic demand remains weak, with inflation still in negative territory and foreign investment down over 11%. In South Asia, Sri Lanka cut its policy rate to 7.7% to sustain its fragile recovery amid low inflation and U.S. trade threats. Backed by a $2.9 billion IMF program, the country posted 5% growth in 2024. Finally, stock markets were mostly lower at the week's end as global uncertainty and trade tensions took a toll. In the US, the Dow Jones Industrial Average fell 256 points, or 0.61%. The S&P 500 dropped 0.67%, and the Nasdaq slid nearly 1%. In Europe, Germany's DAX plunged 1.5%. France's CAC 40 lost 1.65%, while the UK's FTSE 100 dipped modestly. Asia was mixed. Japanese Nikkei 225 rose 0.4%, while Taiwan's market edged down. And finally, the European Union is postponing its bank trading reforms until 2027, citing a lack of alignment with the US and the UK, and pressure from European banks concerned about competitive disadvantage. Now, that's your global snapshot for the Global Pulse. My name is Joseph Cox. Stay with us for more on how these global shifts affect our regional landscape on Caribbean Business Review.
In a world of constant change, insight is your greatest asset. At Joseph Cox and Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox and Associates. Insight, experience, impact.
Okay, welcome back. We now transition into our Island Insights section, and we're pleased to be joined today by Mr. Darwin Telemack. And Mr. Telemack is not only chairman of the Port Management Association of the Caribbean, but is also port manager for Antigua's Port Authority. Darwin, you seem to have quite a bit of responsibilities in your portfolio. I can't say that I envy you. But, let me start our conversation this way, because it strikes me that we are in a landscape now that's defined by tariff conflicts, nearshoring. I mean, frankly, from day to day is a new dynamic. The question really is, how exposed are we in the Caribbean and our Caribbean ports? And frankly speaking, are we prepared for any prolonged volatility in this market?
Oh, good afternoon to you, Joseph, to your listeners as well.
Mhm.
Um, I think your question is most pertinent when one considers the actual situation that we just dodged a couple of about a month ago. One could very well remember the potential impact of the U.S. government regulations where they were imposing a fee on Chinese vessels.
Right.
This was USTR 301. And the devastating impact of that was suggesting that we, as as the Caribbean, not just Caribbean port, but Caribbean civilization on a whole, was about to be decimated at levels that we couldn't comprehend. I made a prediction, and I was right, that this situation was going to be worse than COVID. For example, what we saw during COVID was a number of shipping lines, mostly global carriers, taking advantage of the opportunity to raise freight rates. And these freight rates went from regular numbers to numbers at stratospheric levels. We're talking about $2,000 a unit to $18,000 US per unit. And that just happened in the world. Luckily, our regional cap, like Seaboard, Tropical Shipping, and some of the other carriers, King Ocean, they did not follow suit. So the Caribbean kind of got away from that massive increase in freight rates. However, because the ships that serve the Caribbean that were built in China were much smaller, that the volume of cargo that you would have to divide the charge from the US government would create a situation where our port rates would go to levels of similar numbers. It would be impossible to predict any other way. And Joseph, just to tie that up, a ship from China can carry 15,000 or 14,000 units. We have no ship in the Caribbean serving the Caribbean that comes anywhere close to them. But those ships would face the same 1.5 million or $1 million charge. So when you divide 500 containers versus 14,000 containers, you get the picture. We were about to be slammed, a body slam.
Yeah, no, but I noticed with some interest because we carried a story earlier on this program about this entity Ship X, apparently out of the Bahamas, where they are talking about they will be introducing a direct shipment from China to the Caribbean. Now, it begged the question in my mind, at least: are our ports do our ports, do we have the infrastructure to accommodate any really large ships that will be carrying cargo? One, and two, because our trade flows are probably not the highest, aren't we running the risk of blank sailings, meaning cancellation of shipments, then you're having alternate delays, etc., etc.?
Well, what I'll tell you though is I am quite excited about the prospect of moving cargo from anywhere in the world into the Caribbean. And I'm excited because that happens in Kingston, Jamaica. Your Kingston Free Trade Terminal, which is owned by CMU CGM, creates the only global entry into CARICOM.
Mm-hmm.
As a matter of fact, you have three major global hubs in the Caribbean, in CARICOM. Well, no, I can't say CARICOM, Caribbean. One is Caucedo in Santo Domingo. Two is Freeport, Bahamas. And the third, which is the largest one, is KFTL in Kingston, Jamaica. Now, the issue is not whether we can move cargo from China into the Caribbean, because obviously the Caribbean does 70 to 80% of its trade within North and South America. The vast majority of it being North America, more specifically out of South Florida. Okay. Now, if you were to look at how that dynamics compared with Kingston as the global entry port, that is what I think I would probably. That's why I'd probably be interested.
Okay.
In looking at. I'm getting a delay.
No man, go ahead. You're okay. You're okay.
Okay, that is how I would be interested in discussing how we can reshape our Caribbean logistics and trade using Kingston. Now, the Bahamas can't really speak of playing that role. They've never really been a part of that process. As it stands right now, the exports from Kingston to the Caribbean, that has decreased. It hasn't grown as exponentially as I believe it should have. Nor do I believe that usage of Kingston Free Trade Terminal, combine that with your very efficient Kingston Wharf, and now the legislation that you put in place for your special economic zone, I think you have the right framework to commence discussing how we can reduce the reliance not on global traffic, but that heavy reliance on South Florida. I think that's a risk we have to look at, seeing how we can manage. Now there are some things we can do. For example, South Florida makes very few things. The vast majority of exports that comes to us back to the Caribbean may very well be sailing through Kingston into Miami, where it is reapportioned, consolidated, and then sent back to us. So my easy question is, why not stop the traffic in Kingston, send it to Caledon Hamilton at the special economic zone, do all of the remakings there, and let's start retooling the region to provide a greater sense of security, at least in terms of transport for our people. We in other words, I don't think that the quest to renege our logistics should require that we start looking at making other things ourselves. We are in a global space, and therefore what we have to look at is how do we design a logistics platform that can sufficiently deliver efficiently, cost effectively, and within a certain timeline to our people.
No, I hear you on that, but one of the things that, well, two things really jump out at me. One, did we not learn anything coming out of the COVID experience, to be frank with you? And two, you still have the challenge, what I call inter-island transfers now. I mean, a lot of the countries, honestly, they work with less than container loads. And you have issues now whether or not they have sufficient goods to really make it worth the while. And then, of course, you have the attendant delays and, of course, higher costs. Now, I mean, to be truthful, we're from where you sit. You're both chair of the Port Management Association, but you're also in charge of the port in Antigua. And frankly speaking, Antigua, with your 365 beaches, one figures that, you've been doing some port expansion there as well. One would figure that you would at least have your finger on the pulse as to how to treat with some of these things more effectively.
Well, I think COVID gave us lessons, but when you grow up, your mother likes to say you have a hard head. You hear that all over the Caribbean. You hear that? All right, so I think that might be the case. We saw significant vulnerabilities. One of the things that we have to commend, and Joseph, I don't think we've done that officially, is that our regional line, they didn't fail us. They struggled through low volumes, scarce cargo, and they kept coming. So there is a commitment that we recognize from the shipping lines that serve them. But we're not just talking about a shipping issue. The availability of products became a challenge because the U.S. government prioritized their citizens over us. And frankly, one you expect that. However, where I believe that the discussion goes wrong is when you begin to discuss solving the food supply, the transport supply, and the logistics capabilities of the Caribbean, and only focusing on Barbados, Trinidad, Guyana, and Kingston is not in the middle of the discussion.
But with that, we have to thank Mr. Darwin Telemack, who is a chairman of the Port Management Association of the Caribbean, as well as a port manager for Antigua's Port Authority. Darwin, thank you so much for coming on. Hopefully, we'll be able to do this again when when you have stronger bandwidth. But nonetheless, we are grateful for your intervention thus far. So thank you very, very
In a
much.
world of constant change, insight is your greatest asset. At Joseph Cox and Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox and Associates. Insight, experience, impact.
Okay, welcome back. You know, as we go into our strategy deep dive, we're quite pleased to welcome Dr. Devon Gardner, who is a senior partner at the Institute for Innovation and Growth. And we're going to be speaking with Dr. Gardner today about the imperatives in the renegotiation of electricity licenses. Now, a number of countries have been going through this process for a while, from Jamaica, Grenada, Barbados, probably Cayman Islands, if memory serves well. Everybody is going through the same type of thing. And I want to have this conversation with Devon as to whether or not there are some commonalities, so that one, we avoid going down the road we have before, and two, come out of this with perhaps something that actually works to the benefit of all parties concerned: utility, government, consumer, and so on. So welcome, Devon Gardner, to CBR.
Thank you, Joseph.
All right, great. So Devon, let me start this by a simple question for you. In terms of renegotiating the electricity acts and the electricity licenses that are governing utilities, what are some of the imperatives that you see that are absolutely critical for the governments to focus on, so that we end up with an optimal solution?
Well, when we look at the lens, one of the first things we need to is that there is different ownership of electric utilities. And those ownerships typically do with our licenses. If the utilities privately owned, private owned, then you'll find that the license to be a lot more cheap and is usually good. The kind of commercial agreements, like you would have in the chip and the deal and with us, opposed to some of the utilities which are government. And so what you tend to do is that government is that the license tend to be more provisional, which the utility will be managed. It's not as much commercial aspects. So, that's one of the things we find. The challenge tends to occur because countries mostly with partnership with private. We are in some instances with this and in this instance, in Grenada, from private to you also saw that. So we try to reverse them. It's a lot, and when governments, in order to manage the soft utilities, it's not critical because government has control. It is private sector when the licenses to a large extent.
No, I hear you, but one of the arguments I've heard being put forward is that, for example, the government should be putting in place shorter review cycles, open access provisions, etc., to the IPPs and so on. And IPPs, of course, are independent power producers and so on. But the question really is, what is this effective sweet spot? You cannot be looking at somebody and a company, a commercial enterprise, and saying you want them to put in millions and in some cases billions of dollars of investment. And then you look at them and you give them a short term, a 5-year or a 7-year period within which to review and renegotiate. Is that even feasible?
This is the thing about it. We have not yet figured out what the own ability within many jurisdictions. That's why it's coming to it. Because there is the actual vertical utility laws, the transport, the supply, and the sales of energy. And in those instances, as always, countries are trying, especially because countries are trying the generation side. This and even the supply side, things like green, it's making it a lot more complicated. And so, if we are clear utility role and function, it's going to negotiate the last. Understand how where this for responsibility will comes with that negotiation. That's what Barbados trying to do. They have had a lot of challenges. They have a lot of experience in doing that. Coming down and licenses into 5 different. No longer do you have the utility role in one single license, generation, transmission and distribution, and dispatch and sales. So you have to own all 5 licenses to do, and then there are options for them to also allow into different aspects of the sector. In the case of Jamaica, JPS would have maintained a single license, would have opening up aspects of the other areas like Jamaican to IPP. That's what I said. Now, the thing about the distribution part of the license, that part has to need some time trying to understand what we are going to do with this and grid service distribution systems. The systems for because we have not this kind of investments that are transmission distribution effectively, and that is really, I think there is a lot of that is necessary to support negotiation. That's where the focus. The generation side is one which the utilities love because money is there. I think because of many countries are attract the countries are careful. I think pushing the utilities of the generation and bringing in more IPPs, the GSOs distribution side unattractive for the utility. Therefore, making it for negotiation of license profitably and in a way that able to maintain its distribution.
No, I hear you on that, but you see, part of the challenge that I'm facing with now, I've faced with, frankly, reviewing this issue, is, and I don't know if Jamaica is the exception, but when a government has to commit or looking to commit $13.2 billion over 10 years to treat with an issue where you have 30% illegal abstraction of electricity. I don't know if that obtains in other countries, but that seems, that is a very weak, to me, very weak base on which to initiate as is a real substantive negotiation. What do you think?
Yeah, the thing about that, we kind of give up some of our leverage in that's we revised the elect 16 and we made provisions for to be a shared between the utility and the government. Prior to that revision, it was utilities' responsibility to create steps to prevent the loss of electricity through the distribution system. And the losses were on was required to take steps to present was the regulator and how to reduce losses. That's losses. And when losses, and the utility had to come to its plan in terms of how those losses to the regulator, and then the regulator and the utility would seek to those losses. The utility was able to pay 16, and the government accepted. There was partial funding from the government side because there was that there was a social factor there that government was. And as a result of that, have a leverage in negotiating in that sense.
Well, let me ask you this, Devon. Is there any other Caribbean country where you have that level of illegal abstraction of electricity? I'm curious.
The countries that are like Jamaica, the closest you would be, countries that have these levels of Caribbean would be here. And to a lesser extent there. But yeah, Jamaica is a big difference.
But let me switch tack on you then, because it seems to me that, because I remember at one point we used to hear a lot about transforming our energy base to take on board more renewables, to have electric vehicles, etc., etc. But at the same time, one could not help but recognize that in most of the countries across the region, the power infrastructure is woefully outdated. And therefore, any type of, I should call it, modernization effort is likely to end up in a really unstable supply, if not outright collapse of your grid. Now, how do you get that sweet spot? How do you get the investment in, well, okay, you're looking at something new, for example, a new boiler, a new generating plant, you're looking at probably what, 30, 40-year investment, eh? How do you realistically look at somebody and say, okay, you put in that, but at the same time, we're transitioning to renewables? How does that work?
And then a lot of those things are delicate part between consent, the electricity, it should go through the disease and the one. So you want to make sure that consent is such that you are trying to bring the now you is targeted. You're bringing in a lot of to overlap with the of some of the existing generation. We have to in other instances is that the planning side or the planning systems are not as integrated or as effective as they should be. So they're still in many other countries are integrated resource planning. It still is a true way of doing electricity. Some are doing better than others. So the plans will emerge. When the plans are emerging, process of bringing in new generation because the actors that are involved is really the one who's implemented. But at the same time, for the plan to be implemented, there are IPPs who are supposed to be sending that are supposed to be controlled in many instances through the regulator that procure generation. So you know about spark inside of the utilities generation. And bring that generation. And the utilities don't aspects of the plan in terms of the retirement of the existing generation, grades of the transmission, accommodate some of these, as well as the distribution who are making the investment systems. In some of the systems, and geothermal, other type of common line, in our, and sometimes get by 5 gets to the stage where I've been holding out on the retirement as some of these generators, trying to hold out on the because it needed to be increasingly unreliable. Reliability of the system because they are conservative in many instances. Development of becoming in the timelines requires and requires and so there is a between the planning and unfortunately what is multiple. We find that time away. And so that any your generators not here that reduce the area from generators. Pass your time and that they are unable to do something new generation from oftentimes.
Yeah. All right, Devon. I think that's where we have to leave it. I mean, there is so much more that we could discuss on this matter, and I do hope that you'll be able to join us on this program on another occasion where we can delve into more details. Because I mean, honestly, I'm at the stage where skepticism, I suppose, is the order of the day. Because I keep saying we set, for example, all these wonderful renewable energy targets. We're clearly not going down that path. We claim we are looking at the whole renewable energy base, but the commitment to same is sometimes it leaves a lot to be desired. So, and of course, we can't get around the matter of the consumer. We have to put in place things for what I call the prosumer, the persons who have the small they call it household grids and we call it solar plants, etc., and the ability to sell to the grid, etc. I mean, there's so much more that we have to look at, but it just seems to me that this is a conversation that we need to be having and keep having for us to get this thing right, because our electricity rates are too high. They're too high.
There needs to be clarity on we would see is fully functional for the system. That's what the game has changed. We have not sufficiently figured out exactly how in this new electricity system.
Absolutely.
That's why we're having so many.
Absolutely. Well, all right, Devon, we have to leave it there for today.
Yeah.
So thank you very much, Dr. Devon Gardner, Senior Partner at the Institute for Innovation and Growth, for your insights today. We do hope that we'll be able to have further conversations on this issue as we go forward. But thanks again.
Thank you, Joe.
Well, this wraps up our discussions on Caribbean Business Review for this week. I wish to extend our profound thanks to Mr. Darwin Telemack, Chairman of the Port Management Association of the Caribbean, and Dr. Devon Gardner, Senior Partner for the Institute for Innovation and Growth, for their insights into today's program. We should thank you, our listeners and our viewers, for your attention on this program. Please, for those who are interested in receiving the Caribbean Financial Dispatch, our new newsletter, I would invite you to email us at caribbeanbusinessreview@gmail.com, or of course go on josephcox.org and leave a message on our message board so that you can be included on the mailing list, at least for this time. But at the same time, we invite you all to please like and subscribe to this broadcast, because that will help us to grow. We have taken into consideration your comments, and we do thank all of those who reached out to share their perspectives on our initial broadcast, and we will be guided accordingly. Also, as we take our leave of you this week, I wish to once again send my best wishes to my co-host, Sherry Ann Farquharson, who is a bit under the weather this week and was unable to join us. But at the same time, we have seen that we have had challenges, and the challenges continue to abound in this region when it comes to bandwidth and so on. But we continue to soldier on, because the perspectives of our stakeholders right across this region are absolutely critical as we continue to navigate these uncertain times where week by week, sometimes an hour by an hour, policies change and change radically. But with that said, ladies and gentlemen, I thank you for your attention. My name is Joseph Cox. Next week, God's willing, we'll be right back here to do it all over again. So until then, do take care.